Bob, I want to come back to you. We know in this news conference, somebody's going to ask about these easing financial conditions. I guess it's a two-part question. I've explored it all week. One, how do you expect Chairman Powell to address that question? And two, does it make a difference to market pricing? Do his words carry much weight these days?
He's going to be hawkish, and he should be. He can't sit there. And they've raised rates at the fastest pace since 1980. You've got a period ahead where you're going to see what those cumulative and lagged impacts are. You can't have the markets running roughshod ahead of you and rallying like crazy. Will it matter? Absolutely not. I've been out the last 3 months meeting with clients everywhere. Institutional clients, wealth management clients, retail clients, U.S. clients, foreign clients. Not a single one has said to me, oh my gosh, I have too many bonds. What should I do? When should I get out? Every single one has said, how do I get into this bond market? What should I buy? When should I buy? Where should I buy? And we tell them, buy an aggregate bond fund now, get in. Once the Fed is finished, the entire yield curve is going to ratchet lower. Regardless of whether they have to come back at year end or not, our view is to look at where bonds are and predict the bond market. I think this summer, once they pause, there's so much money waiting to come in, the entire Treasury yield curve will be 3% from 2 years to 30 years.
Bob, let's pick up on that. You've got the menu of fixed income. They come to you, they want to put money to work. They haven't owned bonds, not for a couple of years, as you've indicated, maybe for 5, perhaps even longer. Sovereigns are at the top of that menu. You've got high yield credit somewhere near the bottom. What do you tell them to buy? Never mind a diverse fixed income fund. I don't want that right now. I want to hear from you where you are on high yield junk credit, which has rallied to start the year and spreads are tighter. What are you telling them?
So we've done great on investment grade. We've owned tons of municipals. We've owned external emerging market debt. We've owned investment grade corporates. We've owned securitized credit. And we lengthened duration. We did great. We've stayed away from high yield because our analysis shows us that the peak in high yield credit spreads always comes during a recession. It could be fast, just like the peak in Treasury yields in October happened very quickly, but that's when it happens. So we think high yield is a latter half of 2023 trade. Here's where we've been wrong, where we've looked at how much tightening they've done, how fast they've raised rates, and we thought that period from last rate hike to recession, which is normally about a year, would be compressed to a couple quarters this time. And actually, it looks like it's going the other way, that the accumulated excess savings on all the balance sheets that I talked about is helping to absorb that. But it's not enough for us to get into the high yield market full-fledged.